very slow to invest. We're being careful. We think that there might be a potential correction down the road here. And so especially with the election coming up and concerns about interest rates going up in December potentially. So dollar cost averaging and globally diversified, always diversified.
Okay, but U.S. equities primarily?
No, we also invest internationally as well, and also in alternative investment strategies. And in fact, I think a lot of asset managers are expecting very low returns going forward for equities and fixed income. So we're exploring adding as much as we can to the alternative sectors potentially.
What's the playbook for the fourth quarter? Do you buy the winners of the first three quarters, or do you buy the losers hoping that they're going to catch up? In terms of the winners, we've got energy, tech, industrials, underperformers, we've got real estate, financials. What do you do sector-wise?
Well, I think that value stocks have been bid up, and everybody, investors worldwide, are looking for yield. So in the U.S., we can get maybe even north of 3% on good stocks. And so I think right now we're overweight a little bit into consumer staples. Consumer staples tend to work well later in the business cycle, and they also provide dividends. So that's a sector we like. We like information technology. We think those types of internet stocks can do well even in a recessionary or slow economy. And also energy. I think that's kind of a contrarian play right now, because I know that energy has taken some of the projections out of the estimates for the second half of the year. But we think that if you can buy oil when it gets closer to 40 on the dips, that's a good long-term investment.
Such a huge election risk in the fourth quarter, such huge political risks, also monetary policy risks. In terms of the election, who's better for stock markets, Clinton or Trump?
I think the market has Clinton kind of predicted as the winner right now, and I think if Trump starts to move ahead in the polls, I think we're going to see a little bit more volatility. But long term, I know that a lot of people believe that maybe tax reform, maybe immigration reform in the United States would be good for the economy and really help boost the economy to higher growth rates.
We just had a lovely fellow on from HSBC who I met in the green room. He doesn't like U.S. equities that much at the moment. In fact, they're sitting 14% in cash. They're looking a lot at emerging market debt at the moment as well. And he thinks that a change is coming based on all their economic indicators. You don't fear anything at the moment, or like a big change is upon us. And also, I was looking at some analysis recently, and some people were saying, well, it smells like 1999, especially when you look at some of the U.S. tech earnings.
Yes, I know that some people feel that the stock market's overvalued, maybe at the higher range of valuations, and we're cautious. So we haven't had a bear market since 2009, and so we're telling our clients to manage expectations, look for the volatility, but also be opportunistic. When we get these corrections, maybe they're good buying opportunities for long-term investors.